Nvidia just made history. The California-based chipmaker has officially surpassed a $4 trillion market valuation, becoming the most valuable publicly traded company in the world, eclipsing tech titans like Apple and Microsoft. This isn't just a headline. It's a turning point in the global economy, signaling that AI infrastructure is now as valuable as smartphones or operating systems. But here's the question. Is this growth justified by fundamentals, or are we entering the dangerous territory of hype and overvaluation? Let's explore what's really going on beneath Nvidia's staggering valuation. Just 2 years ago, in mid-2023, Nvidia's market cap was hovering around $1 trillion. Fast forward to July 2025, and it has quadrupled. That's a gain of over $3 trillion more than the combined market cap of Meta and Amazon. This meteoric rise has been driven by one thing above all: artificial intelligence. Nvidia's core business is no longer about gaming GPUs. It's about powering the digital brains behind AI models like ChatGPT, Gemini, Claude, and thousands of enterprise-level LLMs. Its H100 and newly launched B200 chips are critical infrastructure for modern AI development. They're used in training foundational models, running inference, powering autonomous vehicles, building digital twins, and more. Nvidia isn't just a chip maker. It has become the arms dealer of the AI gold rush. In its latest quarterly report, Nvidia posted $1.26 billion in revenue, $2.14 billion in net income, 3 profit margins near 60%. Even more impressive, its data center segment, driven by AI, grew over 400% year over year, now accounting for more than 80% of total revenue. This level of performance is almost unheard of, especially for a company that already sits at the top of the S&P 500. But Nvidia's strength isn't just hardware. It has built a comprehensive ecosystem. From CUDA, which gives developers deep-level control over GPU performance, to its Omniverse and AI-as-a-service platforms. These software layers lock developers in and make it harder for competitors to steal market share. It's the same playbook Apple used with iOS and the App Store, only this time for AI compute. Tech giants like Microsoft, Google, Amazon, Meta, and Oracle have all rushed to secure Nvidia chips, often buying years in advance. Even countries are joining the frenzy. Saudi Arabia, Singapore, and South Korea are building national AI infrastructure based on Nvidia GPUs. Some governments are even offering subsidies to ensure access to Nvidia hardware, treating it like a strategic resource. It's no exaggeration to say that Nvidia has become the oil supplier of the AI economy. But no story is perfect. And Nvidia faces real challenges. First, geopolitical risk. The US government has imposed multiple rounds of export restrictions targeting China. Nvidia's most powerful chips, like the H100 and B200, are now banned for sale in that market. China has historically represented a large portion of Nvidia's revenue. Losing access or even reduced access to that market could hit future growth hard. Nvidia is also heavily reliant on TSMC, the Taiwan-based semiconductor manufacturer, for production of its most advanced chips. Any disruption in Taiwan, whether political, environmental, or military, could cause significant supply chain problems. There's no easy alternative. TSMC is currently the only foundry capable of producing chips at this level of complexity and efficiency. In a world of rising geopolitical tension, that's a risk investors can't ignore. Then there's the elephant in the room, valuation. At over $4 trillion, Nvidia trades at a forward price-to-earnings ratio above 65. That's more than double the S&P 500 average and higher than most historical tech leaders, even during the dot-com boom. Analysts are split. Some believe this valuation is justified, given Nvidia's dominance and expected growth. Others warn that perfection is priced in, and any stumble could lead to a sharp correction. It's a fair question. Is Nvidia becoming the Cisco of the AI era? In 2000, Cisco Systems was the most valuable company in the world. It dominated networking infrastructure during the dot-com boom. But after the bubble burst, Cisco stock lost over 80% of its value and never returned to its peak. Could Nvidia follow the same path? Or is this a completely different scenario, one backed by real revenue, real adoption, and structural transformation? While Nvidia leads the market now, the competition is heating up. 1. AMD is gaining traction with its MI300 accelerator. 2. Intel is reviving its AI strategy with Gaudi chips. 3. Startups like Cerebras, Grok, and Tenstorrent are building alternative AI hardware with novel architectures. 4. Even Google and AWS are developing in-house chips to reduce reliance on Nvidia. If any of these alternatives gain significant ground, Nvidia's pricing power and growth trajectory could come under pressure. Despite the risks, many long-term investors remain bullish. Here's why. 1. AI isn't just hype, it's reshaping how businesses operate. 2. Nvidia is miles ahead in terms of performance, supply chain maturity, and developer ecosystem. 3. It continues to innovate, with plans for the next-gen Blackwell architecture and even quantum AI research. 4. It may soon earn revenue not just from chips, but from AI services, licensing, and full-stack solutions. If Nvidia executes on this vision, it could become the next trillion-dollar revenue business, on par with Amazon Web Services or Apple's iPhone ecosystem. So where does that leave us? Is Nvidia an unstoppable AI giant, driven by innovation and real-world demand? Or is it an overhyped, overvalued stock that's riding a wave of speculative mania? The truth is, it might be both. Yes, Nvidia is changing the world. Yes, its current valuation is aggressive. But if AI truly becomes the backbone of the global economy, then Nvidia isn't overvalued. It's underestimated. What do you think? Is Nvidia still a smart long-term buy, or is it time to take profits and move on? Drop your thoughts in the comments. We'd love to hear your take. And if you enjoyed this breakdown, be sure to like, subscribe, and share for more global finance insights right here on FinSight Global.